My name is Jaime Besa. I'm a director at ChileDay, and it's my great honor to introduce our next speaker, Mrs. Rosanna Costa, Governor of the Central Bank of Chile. Mrs. Costa has a bachelor's degree in business administration with a minor in economics from the Pontificia Universidad Católica de Chile, and is a member of the Presidential Commission, was a member of the Presidential Commission on Pension Reform in 2006, the Presidential Commission on Labor and Equity in 2008, and more recently, the Advisory Council Against Conflicts of Interest, Influence, Tracking, and Corruption. Please join me in welcoming Mrs. Rosanna Costa.
Thank you, Jaime. Good morning. Good morning. I would like to thank Invest for this effort. It is a great effort to prepare this and to have this audience every year, year by year here in London. Also, thanks to the authorities present, senators, Minister of Finance, Solange, and all the sponsor that is behind this event. It is always a pleasure to share this opportunity with such a distinguished audience. This instance has become a long-standing tradition to showcase the progress and opportunities of our country. Just under a month ago, the Central Bank of Chile celebrated its centennial, 100 years of commitment to the country's welfare. Today, I would like to dedicate my presentation to the two central aspects of our mandate: price stability and the normal functioning of payments, both of which guide every decision we make with responsibility and a long-term vision. I will begin by examining the evolution of the Chilean economy amid external tensions, its outlook and implications for monetary policy and inflation. Last week, we published our monetary policy report for September 2025. So I will draw on that document for this part of my presentation. I will take the second part to refer to how means of payment have developed in Chile. The use of digital payments has grown rapidly over the last decade in our country, with the central bank playing a significant role in supporting this transformation. Looking ahead, the challenges remain significant, so I will take this opportunity to outline them and the initiatives we are developing. Let me start with monetary policy and macroeconomic evolution. This year has been marked by the considerable uncertainty on the international front. As you will recall, in early April, the US government announced a widespread increase in tariffs applied on all countries. This process has been quite volatile, but we continue to anticipate that it will have negative effects on global activity. In any case, so far, the impact of tariffs at the global level has been moderate on economic activity and inflation. In terms of economic activity, the available data show significant changes in global trade flows caused by advanced imports in the United States, especially in the first part of the year. On inflation, there are early signs of the effects in the latest US CPI data. These showed a rise in inflation for goods most exposed to tariffs, although this was offset by falls in the prices of other items in the basket. In other countries, including Chile, no repercussions have been observed, although several observers predict that the trade diversion could put some downward pressures on inflation. One factor that remains a hallmark at this juncture is the response of global financial conditions. Their behavior has been benign relative to what could be anticipated from equivalent shocks helping to mitigate potential adverse effects on emerging economies. However, the global scenario remains complex, fraught with geopolitical, economic, and institutional tensions, so there is the risk of an abrupt reversal in financial conditions. Now, turning to the local economy, the Chilean economy has resumed a growth trajectory more in line with its trend growth, close to 2% annual rate. On our latest monetary policy report highlighted that activity had been more dynamic than we anticipated, sustained by some transitory elements that have gradually dissipated, as we expected. Indeed, second quarter activity data was in line with expectation. You can look there. In this figure on the left, we have a graph showing a more pronounced demand cycle, the red line, with a recent acceleration. And the green line shows total output excluding mining, and this dynamic demand has a component of imports of capital goods. On the right, the monthly activity index shows widespread upward trends, although in the aggregate others, there is sectoral heterogeneity. Unlike economic activity, domestic demand was more dynamic than expected in the second quarter. Investment accelerated particularly in machinery and equipment. The upturn in investment has been largely driven by large-scale projects related to the mining and energy sectors, coupled with somewhat more favorable financial conditions and improved business confidence. Multiple indicators continue to point to a favorable evolution of this component of demand. Among them are the evolution of capital goods, imports, and the survey of Capital Goods Corporation for the second quarter, which once again reflected an improvement in the investment outlook for the 5-year period 2024 to 2028. On the left, within the GFCF, two components with different trajectories can be distinguished. Machinery and equipment, the blue line, showed a significant recovery, but only after a previous decline. Construction and public works, the green line, also recover, but at a slower pace. On the right, the survey of the Capital Goods Corporation highlights increases in the stock of projects in the pipeline for the period 2024 to 2028. Especially in the mining red bars and energy black bars. This is a code that came with me during the travel from Chile. Sorry very much. Private consumption has also displayed greater than expected growth in the second quarter. The increase in consumption has been accompanied by favorable developments in some of its fundamentals, such as the financial situation of household and consumer expectation. In addition, labor income has continued to rise, albeit at a slower pace than it did in previous months. You can see there in the figure private consumption, consumer confidence, and real wage bill, or what we can call labor income. Against this backdrop, our last monetary policy report forecast an improved outlook for activity and demand. The main adjustments are in investment and consumption. In both cases, this is influenced by a higher starting point left by the most recent figures and improving fundamentals, including improving consumer and business confidence, as well as better financial conditions. In particular, investment remains primarily focused on large mining and energy projects. Mining projects are underpinned by a sustained demand outlook associated with technological change, the development of clean energy, and increased defense spending. Energy projects, in turn, are supported by growing demand driven by the adoption of new technologies. You can see there, in these graphs, the adjustment made to project levels of consumption at the left and investment on the right across the March, June, September 2025 reports. For economic activity, GDP growth ranges have undergone moderate changes. On the one hand, as I mentioned, unlike domestic demand, economic activity has performed in line with last June's forecasts. On the other hand, a significant portion of increased domestic spending is directed towards imported goods, which is reflected in a higher projected current account deficit. This couples with the negative effects of various factors on mining output. Thus, for 2025, the lower bound of the range forecast in June is raised to 225 to 75%. For 2026, it is adjusted up to 1.75% to 2.75% and is maintained at 1.5 and 2.5 for 2027. Moving on to inflation, the annual variation of the total CPI has continued to decline as expected, reaching 4% annually in August. It is important to note that monthly inflation data for recent months has shown important fluctuations, which has made it challenging to accurately interpret inflationary trends. Bear in mind that between June, July, and August, we went from monthly CPI variation of minus 0.4 to 0.9% and now to 0%. Core inflation, in turn, that is the CPI that excludes volatile prices, has been above our forecast. In August, its annual variation stood at 3.9%, higher than a few months before, and the projections made in our June monetary policy report. When we look at the behavior of its components, we see increases in both goods and services. These take place in a context of increased demand and elevated costs. You can see there inflation indicators at the left, annual change in total inflation, volatile CPI in green, and the core inflation in red. And on the right, you have the different components of the core inflation. You have core goods in blue and core services in yellow. Considering all these factors, our projections suggest a trajectory for headline inflation similar to that foreseen in June. However, we anticipate that between the end of this year and the first part of next year, core inflation will be higher than we assumed in June. Therefore, inflation is expected to converge at 3% in the third quarter of 2026. However, given the greater persistence of the core component, we must closely monitor its evolution precisely because it is a better indicator of trends than total inflation. Headline inflation follows a trajectory very similar to that of June on the green line in the left-hand chart. However, its composition has changed. Core inflation is projected to increase in the coming quarters compared to June. In contrast, volatile inflation shows a downward adjustment in the latest projection. Let me now turn to the implication of this analysis for monetary policy. I would like to begin by recalling that our monetary policy meeting last week, we decided to maintain the monetary policy rate at 4.75%. We made this decision in a context in which, again, the projected path for headline inflation in the September report is similar to trajectory outlined in the June report, but with higher core inflation over the next 12 months, higher than we considered in June. Given that this component of DPI tends to be more persistent, there is a greater need to closely monitor its evolution and fundamentals. Furthermore, we communicated that we will evaluate the next movement of the monetary policy rate considering the evolution of the macroeconomic scenario and its implication for inflationary convergence. In the current conditions, the risk of greater inflation persistence calls for gathering more information before continuing the process of leading the monetary policy rate to converge to its neutral range. For some years now, our monetary policy report contains the monetary policy corridor. These are sensitivity exercises which, while maintaining the GDP growth within the expected ranges, require somewhat different monetary policy action. It is important to reiterate that neither the central scenario projections nor this corridor continues to a commitment by the board regarding the future trajectory of monetary policy. They are based on a set of assumptions which may or may not become a reality. Therefore, we always reiterate that monetary policy decisions are made on a meeting-by-meeting basis, analysis the data we collect, how it fits into the macroeconomic scenario, and what it implies for the convergence of inflation to the target. Before moving on the next part of my presentation, I would like to repeat that the Central Bank of Chile will conduct monetary policy to ensure that inflation converges to the 3% target, which is a fundamental aspect of macroeconomic stability and the people's well-being. Let me start with the second part, the evolving landscape of retail payments in Chile, where we are and where we are headed. Facilitating the payment has been a core function of central bank since their origin with the issuance of legal tender, one of the most visible expressions of that role. At the Central Bank of Chile, our mandate includes not only preserving price stability, but also safeguarding the normal functioning of internal and external payments. As the digital economy grows, access to electronic means of payment becomes essential. Individual and household without such access risk being left behind of an increasingly important part of the economy, much like mobile phones or the internet payments. Digital payments are no longer a luxury or convenience, they are increasingly becoming a necessity. In this context, while central banks' mandates on payments remain unchanged, the way we interpret the act on those mandates is evolving. Increasingly, our focus is shifting towards digital payments. In this part of the presentation, as I mentioned earlier, I will describe the rapid growth of digital payments in Chile over the past decades, the role that the central bank has played in supporting this transformation, the initiatives we are currently pursuing, and some of the challenges that lie ahead. A decade of transformation in Chile's payment industry. Over the past 10 years, Chile's payment industry has undergone a profound transformation, becoming a vibrant sector with many growth opportunities. One of the most striking figures from our last payment system report, published just 1 month ago, is this. In the last year, the average number of digital payments per person in Chile reached 374 per year. This includes both card transactions and account-to-account payments. In simple terms, people in Chile are now making digital payments at least once a day, and the total value of these payments amounts to 112% of GDP. This marks a significant shift from 2016, when the average was 80 digital payments per person, representing 60% of GDP. If we look specifically at card payments, they accounted for 32% of household spending back then. Today, the figure has more than doubled to 74%. As can be seen in the figure, Chile's payment industry has undergone a profound transformation in the last decade. By far, debit cards are the most widely used digital payment instrument for transactions. The yellow area you can see there. However, electronic funds transfers represent 65% of the value of transactions, the blue bars. The use of prepaid cards is increasing considerably, albeit from a small base. This growth is largely driven by high levels of financial inclusion. In Chile, anyone can open a simplified account and access a debit or prepaid card, often free of charge or at a very low cost. A recently developed, robust network of acquirers and sub-acquirers ensures that these cards are widely accepted by merchants across the country. Also, Chile was one of the first countries in the world to have instant account-to-account payments. That system, operated by a private company and regulated by the central bank, processes millions of transactions daily, mostly between individuals. Looking ahead, we expect this momentum to continue. Innovation and new technologies are lowering barriers to entry, enabling new business models and services for consumers. At the same time, the FinTech law passed in 2023 and the ongoing development of an open finance system are designed to foster competition and further expand the market. In recent years, many new payment companies, including issuers of prepaid cards and acquirers, have entered the Chilean market, some of them from abroad. We see this as a strong vote of confidence in the future of digital payments in Chile. As I will discuss below, despite high adoption rates, there is still significant room for growth. You can see there the growth in digital payments per person, merchant accepting card payments, registered acquirers, and prepaid card users. What is the role of the central bank in supporting safe and inclusive payment innovation? The Central Bank of Chile has played a key role in enabling the transformation of retail payments, ensuring that innovation happens in a safe, orderly, and inclusive manner. As major milestones came in 2017 with change to the regulation of payment cards. This reform laid the foundation for the adoption of the four-party models, which opened the market to multiple acquirers and sub-acquirers, fostering greater competition and expanding access. Before that, in the three-party model, the roles of issuers and acquirers were combined into a single entity. Since this industry is prone to innovation and dynamism, regulation has continued to evolve. Some updates have fine-tuned prudential requirements, but others were aimed at providing a framework for new business models, such as cross-border acquiring, on-us payments, and more recently, the integration of payment cards into public transport systems. At the heart of our regulatory approach is a clear objective to ensure that retail payments function reliably and securely. To achieve this, we impose prudential requirements, including capital and liquidity standards, to mitigate credit and liquidity risk. We also require robust risk management policies to address operational, fraud, and cybersecurity risks. A key concept in our framework is payment responsibility. The need to clearly define who is ultimately responsible for fulfilling payment obligation to merchants or other payment receivers. This clarity is essential given our legal mandate to safeguard the integrity of the payment system. However, regulating issuers and acquirers alone is not enough. Behind the scenes, financial market infrastructures, the plumbing of the financial system, play a critical role in ensuring that payments are final and that clearing and settlement process minimize credit, liquidity, and operational risk. While the central bank has long regulated large value payment system, it wasn't until 2020 that retail payment infrastructures were brought under our regulatory umbrella. The Retail Payments Clearinghouse regulation introduced, finally, to retail transaction and strengthened the clearing and settlement process through prudential standards. As I previously noted, Chile's instant account-to-account payment system, operated by a private entity, has been in place for years. Without making much ado about it in international fora, Chile was one of the first countries counting with instant payments. More recently, since 2024, the clearinghouse processing these payments has been formally established as an infrastructure subject to prudential requirements. One notable outcome is that the system is now more resilient and liquidity needs for participants have dropped significantly. Soon, debit and credit card payments will also be processed under this framework. Clearing will take place through Visa and MasterCard's clearing houses, and settlements will occur in the central bank RTS system using central bank money. Importantly, this is not the end of the story. The regulation also promotes interoperability between clearing houses and allows room for experimental projects. These features are designed to encourage competition and support ongoing innovation in the payment ecosystem. As the payment ecosystem continues to evolve, so too must the regulatory framework and the role of the central bank. As I said, new business models have emerged and more will follow. Naturally, many of these innovations were not foreseen when the current regulatory framework was first designed. While we've been able to adapt this rule over time, there are cases where legal constraints limit our ability to respond in such instances. In such instances, new legislation, like the recently enacted FinTech law, becomes essential. One emerging regulatory challenge is the rise of banking as a service, a model where banking products are offered by third parties, often fintechs, through digital platforms. We are beginning to see such initiatives in our country. From a regulatory standpoint, this raises important questions. Do these models introduce new risks? And if so, how should they be addressed? A more immediate challenge is the expansion of account-to-account payments to merchants. Today, most A2A transactions in Chile occur between individuals. However, in many countries, this method is increasingly used for payments to business. While in Chile the technical infrastructure already exists, the user experience remains cumbersome without dedicated interfaces and services tailored for merchants. Some banks and fintechs, including payment initiators, are developing solutions in this space. However, these efforts are often fragmented, limiting their potential. This raises a key question. Can these initiatives be made interoperable? We believe the answer must be yes. Expanding A2A payment to merchants would enhance the resilience of the retail payment system. But to achieve this, interoperability is essential. There are different paths to interoperability. In some countries, central bank has stepped in to provide public infrastructure for retail payments, making a shift from their traditional focus on large value systems. In Chile, we have historically taken a different approach. The public sector regulates and supervises, while the private sector develops and operates most infrastructures. Following this approach, we are studying how our central bank can leverage its regulatory authority to facilitate and foster interoperability across existing and future private initiatives. Nonetheless, we are not neutral about the desired outcome, which is that we expect to see increasing use of A2A transfers for P2B payments in the coming years, and will take the necessary steps to make it happen. Another important challenge is to strengthen the infrastructures that support digital payments. As digital transactions become more prevalent, the systems that process them take on a systemic importance. Any disruption is not just an inconvenience, it can mean lost economic activity. The implementation of the Retail Payment Clearinghouse regulation had made this clearer, and we may need to further strengthen prudential requirements for these systems. Finally, as more participants enter the ecosystem and alternative rails for instant payments emerge, we must ensure that our RTGS system can handle the growing volume of payment instructions. Expanding its capacity is a complex task that requires careful planning and foresight. Looking ahead, emerging technologies and their impact on payments. As the financial system evolves, some technological developments, though not directly tied to retail payments, are beginning to intersect with them in meaningful ways. These innovations require forward-looking thinking and proactive explorations. One of the 3 chapters in our latest payment system report is dedicated to tokenized assets. These are a new class of digital assets that empt traditional information about the underlying assets, along with predefined rules governing ownership, transfer, and trading. While the market for tokenized assets remains small compared to traditional financial instruments, it is growing rapidly. If these assets become more widely adopted, existing financial market infrastructures will need to adapt, particularly to interact with the technologies that support tokenization, such DLT. For example, if securities are increasingly issued on DLT platforms, settling these transactions in central bank money would require central bank systems to communicate with these platforms. There are several ways to achieve this, including synchronization mechanism or the issuance of a wholesale central bank digital currency that is native to these systems. To explore these possibilities, the Central Bank of Chile is preparing to launch a proof of concept for a wholesale CBDC. This initiative is not a commitment to issuing a CBDC, but rather aims to gain hands-on experience with this technology, identify potential gaps, and strengthen our internal capabilities. The project will simulate the transfer of tokenized assets between agents on a blockchain ledger using a wholesale CBDC as the settlement instrument. Another innovation with disruptive potential is stablecoins. These are digital assets pegged to reference currencies, like the US dollar, and backed by reserves such as fiat currencies or government bonds. Dominated by USDT and USDC, which together hold nearly 80% of the $300 billion market, stablecoins are used for cross-border transfers, crypto trading, and settling tokenized transactions on DLT platforms. Although their use in retail payments remains mostly theoretical, it is important to consider that and be prepared for scenarios where this could start happening. In Chile, the fintech law assigned regulatory responsibilities to two institutions. The Financial Market Commission oversees market conduct for crypto assets services providers, such as exchange and custodians, similar to how it regulates securities. Meanwhile, the central bank is empowered to regulate the prudential aspect of stablecoins, but only if they are issued by entities supervised by the CMF Commission as issuers of means of payments. Globally, regulatory efforts are gaining momentum. In the United States, for example, the Genius Act aims to regulate stablecoins, and international bodies like the Financial Stability Board have issued guidelines and best practices for global stablecoins. These efforts could accelerate the growth of stablecoins, especially those with global reach. However, in Chile, enforcing international standards on global stablecoins present challenges. The fintech law requires issuers to be established in Chile and supervised by the CMF. Even if that requirement were lifted, extraterritoriality remains a barrier. This creates a potential regulatory challenge that must be acknowledged and addressed as the ecosystem evolves. After a decade of significant achievement in modernizing the payment system, and with inflation projections that reflect both our accomplishment and the challenges we face, the path forward requires an agile monetary policy capable of responding promptly to emerging risks and an increasingly robust financial system with a modern, safe, and resilient payment system. In this context, we reaffirm that the mandate of price stability and financial stability has not only guided our work over the past 100 years, but will continue to be the cornerstone of our future actions. The ongoing challenges call on us to redouble our efforts, strengthen our capabilities, and continue to act with independence, technical rigor, and public commitment. The Central Bank of Chile remains committed to the well-being of the people and development of the country. I stop here. Thank you very much.